This is the fifth and last part of my webinar series, How to Design a Fundamentals-Based Strategy That Really Works. And it covers strategy implementation. Another way to put that is portfolio management. I'm going to be talking about all the things that you do once you've designed and back-tested your strategy, all the things that you do in order to actually implement it in real time. So I'm going to start with just the basic questions. You've created some factors, you've put them into a ranking system, you've done some back testing, and you're pleased with the results. So how do you actually make money? The answer is that you must develop a strategy that you can stick with through thick and thin. You can't just buy the top ranked stocks willy-nilly and decide when to sell them later. I guess you could. I mean, I know people who do, but it may not be the best move. It's best to figure out how you're going to manage your cash, decide on your position sizing, set limits on when to buy and sell, and so on. By the way, if you have any questions while I'm talking, please feel free to use the chat button and type them. I'll be happy to answer as I'm going. You don't have to wait for the end of the webinar. It's likewise, if you have any technical problems, you can't see something or you can't hear me very well, just put something in the chat box. There are a number of behavioral rules that I follow, and I think, I could go on for pages and pages on these, but I'm just going to devote 2 slides to these. And they're just general good advice for portfolio management. Never make spur-of-the-moment decisions. Always follow a system and modify the system slowly. Never panic. Always remind yourself that if something bad happens, something good might happen next. Accept volatility. It's just part of being in stocks. Every time you make a modification to your system, keep the old version. You might want to revisit it. Only use several systems at once if you feel completely unsure as to which one is better. Otherwise, either combine the several systems into one or go with the better one. Don't make discretionary exceptions to your system. Modify it instead. If your main focus is avoiding losses, you'll never make any big gains and you'll never learn from your mistakes. I know that Warren Buffett's #1 rule is don't lose money, but that's, I think, contrary to the spirit of the way I invest and the way I recommend that you invest. You are going to lose money at some point, and that can actually benefit you in certain ways. Never use stop losses. Remember that the future price of a stock has absolutely no relationship to what you paid for it. It's part of what behavioral psychologists call anchoring bias, using stop losses. If you do want to limit losses and peg your stock price to, something, don't use the price you paid for it. I mean, you could use a momentum measure, for example, the price that it was 10 months ago or 12 months ago or something like that. But even that's not a really good idea, because often if a stock drops in price, it's a great buying opportunity. Don't set target prices. Just sell a stock when you need the money to buy another whose probability of future gains is higher. Add to losing positions and trim your winners. If a stock's rank doesn't change, but it gets cheaper, there's no reason not to buy more. And if a stock's rank doesn't change, but its price goes up, take a little profit. Don't worry about things being too complicated. The stock market is intensely complicated. There's no reason why your strategy shouldn't be too. And lastly, don't follow trends. This is a good rule not just for investing, but for everything in your life. Learning from trading. Every time you make a trade, questions arise. For example, a stock appeared on my screen or simulation, even though it shouldn't have. Why? Investigate. You might need to rewrite some of your rules, or there may have been a data error. For example, I recently discovered that some foreign F shares that trade primarily on other exchanges are not classified as ADRs. So I had to rewrite some of my rules. A stock that I bought was obviously a poor investment because of something that the company did that my rules didn't cover. Again, you may need to rewrite some of your rules. An example from my own experience is that a stock paid a huge special dividend and then didn't issue any new statements for a while. So its real numbers were nothing like what I was seeing. I needed to write a rule so that I didn't buy stocks like that. My system is making way too many trades and I keep buying and selling the same stocks. So in that case, you probably need to rewrite your buy and sell rules to minimize trading and maximize your flexibility. Here are the components of a successful strategy. And I'm going to be going over each one of these in detail. The number of positions, the weights of those positions, the frequency of trading, your holding period, your entry and exit strategies, hedging, margin, and cash management, and using trading techniques to minimize trading costs. The number of positions. Diversification lowers volatility that can depress returns. So where do you find the middling? Where do you find the right balance? A portfolio with too few holdings will be especially vulnerable to market impact costs because you're going to be buying more of each stock. Sudden downturns, missed opportunities. I mean, for example, sometimes the 10th highest ranked stock might be a better choice than the top ranked stock. High turnover. A portfolio with too many holdings will be especially vulnerable to decreased overall returns from holding too many middling stocks, management difficulties, and too much time spent trading and placing orders, oversight lapses, a failure to learn from your mistakes due to not even noticing them. For me, the ideal portfolio size is between 15 and 50 positions. And I've swung both ways. Right when I was starting to invest, I usually held about 15. Earlier this year, I was holding about 50. Position weighting. Put more money in positions that inspire your greatest confidence, and of course, algorithmically speaking. In other words, your top-ranked stocks. But adjust for transaction costs. A stock with high transaction costs might deserve less money than a stock with low transaction costs. I do a pretty complicated thing here. I actually estimate my expected return per position, which is higher for higher ranked stocks and lower for lower ranked stocks. And then I subtract what I expect the transaction cost will be. And then I just weigh my portfolio accordingly. And it's a good idea to rebalance to adjust your stock weights if a position has radically grown or shrunk, or if the stock's rank has risen or fallen. But don't rebalance too frequently. Allow yourself some flexibility. Now, trading frequency. I view trading frequency is really a matter of choice. You could trade daily, 2 or 3 times a week, once a month, once every quarter. That's really your choice. I had a question. By transaction cost, what more than commissions? Market impact cost and slippage, which is due to bid-ask difference. So if I place an order for a thinly traded stock before market open, it's probably going to affect the opening price, especially if it's a large order. And if a stock has a bid-ask spread of 60 cents and it's a $20 stock, that's, a 0.3% cost right there each way, probably something like that. So trading daily can increase your returns because you are more sensitive to price changes. There are more opportunities to buy when a stock's price is low and sell when a stock's price is high. There's increased responsiveness to earnings reports and other news. Stock prices tend to rise or fall much more in the days after a new earnings report than at any other time. It's easier to ease in and out of positions if you trade daily than it is if you trade less frequently. And I'll talk more about this in a minute. Trading less frequently can increase your returns because you drastically lower your transaction costs. Not only that, but it's a lot easier. So a big question to ask yourself is how much you enjoy trading. If you really enjoy it, trading daily can be fun and rewarding. And if it's a drag, trade less often. Remember, a strategy won't break or fail because you don't execute all the trades it requires. Holding period. I think it's inadvisable to have a very fixed holding period. Some stocks you might want to hold for only a few weeks. Others you might want to hold more than a year. The exception is if you're extremely concerned about the difference in capital gains taxes between the over a year holding period and less than a year. If you think that'll make a huge difference to your overall returns, then obviously you do want to have a very long holding period. But I would, in general, advise you to set yourself a minimum holding period to avoid excess churn. Mine is about 2.5 weeks. Even if a stock's ranking drops precipitously because of a new earnings report, but if I bought it less than 2 weeks ago, I'm going to still hold on to it. It's just a rule I have. I don't think it's, I think that you can set your own rules. You can make exceptions to a minimum holding period. But certainly many brokers are going to penalize you if you buy a stock and then sell it again the next day, especially if you haven't cleared the money that you used to buy the stock. But I find it works better for me to have a minimum holding period. So do you buy or sell your entire position at once, or do you ease in and out of positions? And there's advantages and disadvantages to both. Easing in and out of positions comes naturally because ranking systems are unstable. So easing in and out over several days while keeping track of the day's ranks, or even several weeks, can provide you with more stability than simply trusting one day's ranking and buying an entire position on that day. I have seen on a number of occasions a stock all of a sudden is ranked number 3 in my ranking system, and I go out and buy a bunch, and then the next day it's ranked number 28, and it never rises back to number 3 again. And I have no idea why. It could be just some data glitch. That's what it usually is. So that's one argument for easing in and out of positions. Another one is that it dramatically lessens market impact because you're placing smaller trades. The advantage of buying and selling at once is that it allows you to fully take advantage of sudden price moves and to move quickly on earnings reports. Hedging. Now, personally, I don't use hedging, but I do want to talk about it. Temporary hedges. I believe that it's impossible to time the market. So placing hedges under certain market conditions doesn't make sense to me. Timing a market exit isn't terribly difficult. In some cases, it was pretty clear last March, early March or late February that the market was going to really go down, and a lot of people got out. But timing a market entry is, in my opinion, impossible. It's very, very hard to know when to get back in. And the biggest gains are made in the early days of a recovery. Almost everyone who gets out of the market and thus avoids a huge drawdown gets back in at the wrong time. either too early with a subsequent big drawdown, or too late, missing all the big gains. A lot of people can do this successfully, but I think it's very hard, and I just don't advise it. Permanent hedges. That's when you put 5% or 10% or 15% of your money into a short position. Obviously, you have to use margin for that, and that'll smooth your returns. Over the long run, it may diminish them to some degree. The variable hedging, you can use the CBOE volatility index, the VIX, to adjust the amount that you hedge. I know a few people who do this, and I believe that this can be quite successful. I'm afraid I really can't offer any details. I just don't know enough about it, and what I have learned is probably proprietary to the people I've been in contact with. Using options. Some people buy puts or sell call options to hedge their positions. That's quite a popular way to do it. Margin. Margin should be used in small amounts and very carefully. It has to be closely managed. You really must understand how margin works and how it turns small losses into large losses and small gains into large gains. It's also helpful to understand the mathematical relationship between your expected drawdown, your margin debit, the market value of your securities, and your house surplus. Fidelity, my broker, offers a useful margin calculator that really helps with this. And I don't really know what other brokers offer for their margin customers. Margin interest. Interactive Brokers charges very low rates, and everyone else charges high rates. But you can often negotiate those rates down if you threaten to move your funds to Interactive Brokers. If you're paying more than 4%, I think you're paying too much. Using the VIX. The VIX is derived from the prices of index options with near-term expiration dates, and it has a lot of offshoots. Like there's an RVIX, which is based on the index options for the Russell 2000, whereas the regular VIX is based on index options for the S&P 500. I find the VIX to be a pretty decent predictor of market drawdowns. The higher the VIX, the larger the future drawdown. But I think it's a terrible predictor of subsequent market upturns. It's just totally useless. So it's good to use it it's good to look at the VIX when you're using margin, because if the VIX is high, you want to reduce your margin. And so I'm always looking at the VIX and seeing how much margin I really want, and then reducing it. I think if the VIX is going to go above 40 or 50, I'm probably going to get out of margin altogether, unless I've already had a huge drawdown and there's nowhere left to go. I don't know, but I mean that's something you can decide. You can be flexible about it, but it's good to think about that. Now, cash. I believe that cash is trash. Now, most people disagree with me, but I think that because it's so easy to trade securities, it doesn't make much sense to keep a certain amount of cash in reserve in case major bargains appear. In my opinion, you're better off remaining almost fully invested and selling stocks when you want to buy new ones. If it were much harder to sell stocks, then yeah, reserving some cash for great buys would be a good idea. Trading technique. The object of smart trading is to get good fills, which is, in other words, to buy or sell exactly the number of shares you want at the very best price. But there are four major impediments to getting good fills. One is the bid-ask spread might be high. The spread is the difference between the price that sellers are asking and the price that buyers are offering. Two, the depth might be insufficient. Depth is the number of shares actually on offer at any given time. I've been trying to sell one of my stocks for about a month now and haven't found a good price because there's just so few buyers out there. So I just keep placing my limit orders and just hoping that at some point someone will get it. The market impact might be large. Market impact refers to how much your trade will move the price away from your best fill. I've found that market impact goes up exponentially the larger the fraction of the median daily dollar volume you trade. Your timing might be off. Placing your trade earlier or later in the day or waiting until tomorrow might get you a much better price. So those are all the ways that those are all the things that are in your way when you're trying to get a really good fill. Now, for large caps and mid caps, I don't think the first three matter. It's just a question of timing. For small caps and micro caps, all four are important to take into account. Interactive Brokers has a large number of trading algorithms, as well as access to dark pools, which might be useful to reduce trading costs or to get good fills fast. Remember that this is IB Pro, not IB Lite. IB Lite, I don't know how many trading algorithms they have, but they don't get as good fills. They do pay for order flow, and you have no access to dark pools. We have a question if I have a suggestion of how much daily volume as a percentage we should limit our order to. I would say, I'd say 75%. I think more than that, you're just going to be paying major costs. And even then, that's a really high number, actually. Maybe 15% per order. If you break up your orders into small bits, you can go for like 50 or 75%. But if you're just going to place an order, 15% of median daily dollar volume, I think would be the maximum. Now, if you use another broker, not Interactive Brokers, you should really consider how to best place limit orders and learn how to do that. And the only way to do that is to just practice and do it in real time. But I have a lot of suggestions for you guys. I've got a series of slides here, 3 slides about trading microcaps on a non-IB platform. In other words, Schwab, Fidelity, or some other broker. The general guidelines are place limit orders only. If it's a large order with lots of potential market impact, break it up into small orders. And don't commit yourself to getting a complete fill. If the price moves strongly against you, you might be able to buy some tomorrow at a better price. You might not, but if you insist on getting a complete fill, no matter what the price is, you may end up paying exorbitant prices for your stocks or getting very low prices for your sell orders. Part 2 is a simple method that I suggest, and I know a number of people who do this. Just place a limit order before market open at the previous close and then forget about it. If it doesn't get filled, repeat the next day. Whenever I'm on vacation, that's what I do. If I'm not sitting in front of my computer, if I don't feel like sitting in front of my computer, it's a pretty decent way to work. Now, here's the hard method, and this is what I do most of the time. Place a limit order before market open at the previous close plus or minus a generous amount, depending if you're buying or selling. The limit order should be for about 20% of the number of shares you want to actually buy or sell. Keep an eye on it. If it gets filled, immediately follow up with the rest of your buys or sells using limit orders. And if it doesn't get filled, slowly adjust it through the day. If the price moves against you substantially compared to the rest of your stocks, don't go out on a limb. an unfilled order at a bad price might be better than a filled order at that price. And if you see the price move as your orders get filled, that's okay within a certain limit, say 50 or 80 basis points. But beyond that, stick to your limit orders. Now, timing your orders. If you are, this is something I talked about a minute ago about something that will affect even orders for large caps and mid caps. It's very, very hard to time orders by watching a chart. And here's my tip for timing orders, but this is not a foolproof method, and I don't think it's necessarily going to get you better fills. It's just something I've been trying, and I've seemed to have had some success. So you place a small order before open quite far from the previous close. If it gets filled, follow up with more orders. And if it doesn't get filled, replace it with another order somewhat far from the most recent price. And do that again. Again, if it gets filled, follow up with more orders. And if it doesn't, replace it with another order somewhat closer to the most recent price. Now, if the price moves against you a good deal, don't just stick with the reasonable price and don't adjust your order anymore. Now, this is how it works. The price will move up and down during the day. By placing orders somewhat outside the most recent price, there's a 50% chance that the price will move toward your order at any one time. This strategy maximizes the chance that you'll catch that move. For example, this morning, I had an order for a stock that was somewhat below the opening price. It didn't get filled. I adjusted that order and made it somewhat below the most recent price. And I waited a bit, and then bam, it got filled. And then the price went down. So I was able to place subsequent orders for that stock at a much lower price than even my original order had been. So what happens is often the move will continue, allowing you to get better fills for subsequent orders than you did for your initial order. Now, we have a question, how far is quite far? Which is a good question. I use the average true range to calculate what my limit order is going to be. And I'm going to show you on Portfolio 123 how to do that. If I forget, it's going to come at the very end of my presentation, but I'll show you that in a few minutes. We have a lot of tools on Portfolio 123 that help with portfolio management and trading. And you can track your portfolio, you can analyze it, you can import transactions from your broker, you can send IB or trade your orders using live strategies. You can do manual order entry for IB or Tradier. You can place smart limit orders. And I'm going to show you, I'm going to switch from this PowerPoint presentation to the actual website and show you how to do all this stuff. I have a lot of accounts I have a number of accounts with Fidelity, and I have 2 accounts with Interactive Brokers. And I'll show you quickly how I manage these accounts. So the Fidelity account, let's go to Manage and Accounts. And I have my Fidelity account here. I have 2 strategies in it, but one is I'm not using right now. So I'm going to look at this strategy. This is a paper account because Portfolio 123 doesn't have a broker interface with Fidelity. So I keep track of my Fidelity account here. I can look at the overall distribution right here by sector of my holdings. So you can see that I have, hold on. I've hold on a sec. I'm in the wrong data provider here. Using FactSet for my sector analysis here, which is fact, that has way better sector analysis than CompuStat. I have, 14% of my holdings are in business services, 9% are in non-cyclical, consumer non-cyclicals, and so on. I have almost nothing in technology at this point, which is unusual for me, but that's the way things have shaken out lately. So I can also look at the strategy's performance here. So in this past year, this strategy has gone up 120%. I can see how much it went up at any point during the year. I can look at 2-year performance, 3-month performance. I can compare it to a benchmark. I like to use the microcap benchmark here. So I can see that in the last 3 months, I've done better than the benchmark, even though it's piddly returns. Last 1 month has been a bad month, and I have just barely beaten the benchmark there. This actually gives me real-time totals for my stocks. Now I can go and look at my holdings, and I can sort by the return percent. So I can see that, Silverbow's done really well. Art Group has done terribly. I can sort by the number of days I've held the stock. So this is my longest holding, PAM Transportation. And my most recent buy, yesterday I bought OP Bancorp. I can sort by weight. My biggest position is Blue Green Vacations, followed by SB Financial, all sorts of things. I can look at my transactions. So this will show me all the buys and sells I've done lately. And it goes on for all 8,441 transactions. And in the holdings, I can also bring up other things. I can look at the analyst trends of my various holdings. I can look at the fundamentals, and I can download them too. I can filter them. There's all sorts of handy tools with this. Now I'm going to show you. Let's say the day is over and I've made all my trades. That's not the case. I'm planning to trade some more. So I downloaded a CSV file of my of what I did of my from Fidelity, and it tells me, today I bought I had 5 fills for BCD Bank, and I had another 5 fills selling First Business financial services. So I'm kind of trading a lot of banks lately. So let's say I want to import all these transactions into my account. So I'm just going to, hold on, didn't do this right. I'm going to copy this onto my clipboard. This is today's transactions only, because the others I've already imported. And I can click on these 3 bars, import transactions, paste here, identify columns. So I always check this because sometimes it gets it wrong. These look right. It says shares is exchange quantity. This is wrong. So I will put in shares here where it should be. Price, commission, amount. That all looks good. So, and it tells me, okay, 5 orders to sell FBiz. These all look correct. I will then validate the transactions, and then I can click import. Now I'm not going to actually click import because I want to do that again later today. But when I import, it'll import all my transactions immediately. My transactions record, my holdings, everything is updated. So it's a great tool to manage your portfolio. Now, let's go to my IB account. Let's look at this one here. And this is a strategy that I have linked to a live strategy. A live strategy is a it's kind of like a simulation, but it's actually running live, and it tells me what I want to buy and sell. So let's say I click rebalance. Now the live strategies rebalance on Mondays, right? So I've already rebalanced according to the transactions of my live strategy. But I usually use the match positions thing. Now, as you see, it's going to give me all the differences between what I'm holding in the IB account and what the strategy is holding. The strategy is rebalanced only once a week. The IB account is rebalanced continually. So there's going to be differences here. So let's say I want to match. I want to do a bunch of transactions and match the what my live strategy is doing. So I can put in a minimum amount here to reduce the number of strategies and reduce the number of transactions. Let's say I put in $700 as my minimum, and you'll see that a lot of these transactions are grayed out. Now, it's telling me I should buy some more SCX and sell some BDL. So I can do that. That sounds cool. So I'll make this a relative MBBO peg order. There are all these different kinds of orders you can use with IB. We only have 2 of their algorithmic order types in our system at the moment. But I like to use the relative NBBO peg for my automated orders. And so this is going to tell me that this is going to reduce my cash by $370, which is fine because I have $612 here. And so I can click review and send. Now, let's say I want to make these later. With IB, it's kind of hard to sell and buy at the same time. So I could say I want to sell at 240. I want to place these transactions at 240. I'll confirm. Now, if I go to the account level, I can look at my activity, and I'll see that I have these 2 orders scheduled. Now let's say I want to sell the BDL first and then buy SCX, so I don't end up in the red. And so I can click that and press edit, and it'll say, I want to reschedule. So let's say I want to reschedule at 210 instead of 240. So I can just do that and continue, confirm. And now I have 2 orders that are actually going to be buying and selling at different times, which I can't actually see here, but oh yeah, I can. So this is being sold at 210 and this is being sold at 240. I'm going to delete these because I don't actually want to do this. I'm just illustrating. Next, let's say I want to. No, let me change my account here to this other account I have. And I want to, I've got, let's see, click on the strategy so I can see what I'm actually holding. So let's say I want to sell my shares in CPIX and buy some more shares in, I don't know, Triple I. So what I can do is I can say add transactions. So I want to buy Triple I. And let's say I want to buy 300 shares. Now I'm going to show you how to use limit orders. And this is going to show you the way we calculate the average true range, which will answer Kim Brown's question, how far is quite far? We have, so right now the price of the stock is 586. The Patient limit order is going to be 580. The conservative limit order is going to be 583. 583, I think, is kind of the quite far price. The conservative order is pretty close to what I have for the for my own, my own use. And then an assertive order would be 585. Last price, of course, would be 586. So let's go with conservative for all the limit modes for this here. So you can see, so let's say I want to sell CPICs. For some reason, it's not working. All right, let's sell HPP. Not really sure what's going on here. This is not a problem I've encountered before. Well, all right, let's just do another buy order. Let's say I want to buy Apple. Something is stuck. I see. I think we'll exit out. And that's another thing you can do is to add one transaction at a time. So let's say I want to buy Apple. And I want to buy 50 shares. And let's see what it gives me for my limit orders here. So annual, that's conservative, would be 143.97. So that's, 40 cents below the current price. And if I wanted to sell, let's say I want to sell CPICs. And this tells me something about my short-term and long-term capital gains. And let's say I want to choose, and so I've chosen a conservative limit. It's given me 350, 2 cents above the current price as a conservative limit order. So I do this, 2 or 3 times a week. I add transactions manually for this particular account because it's not linked to a strategy that I have on Portfolio 123. Instead, it's linked. Instead, I use a spreadsheet to decide what to buy and sell. So those are the kinds of things that you can do with our manage tools. So I wondered if anyone has any questions about any of this. So here's a question. Is this trans interface available only if you have an IB account? It's also available if you have a Tradier account. The other interface that I showed you, but if you want, I'm trying to think. Let's say you have if you have a Fidelity, if you don't have an IB or Tradier account, can you actually get the limit orders? That's, I think, the question that is implied here. And I believe that is not possible. Well, let me just check. Let's say I want to add a transaction. Buy. Oh, yes, I can. So let's say I want to buy Apple. Let's see. No, it doesn't give me any option to actually place an order. So yeah. So I would to calculate the average true range, there is a formula for that, but I don't know what it is offhand. I will I believe because I wrote a formula that I use myself, which looks at price moves. And the average true range is depending on price moves. So if you Google average true range, yeah, there we go. Stock charts does ATR. So if you look at average true range, you'll get it. And then you might not want to use one ATR. You might want to use 0.5 or 1.5. I mean, it's just something that you have to kind of experiment and see what kind of answers you get. Now, how does the limit mode work? The limit mode basically sets a limit price, and you have to adjust it yourself. If it doesn't get filled, it doesn't get filled. So you might want to, what you could do is start with the patient price for the overnight order. Once market opens, move to the conservative price, then go to an aggressive price if that doesn't get filled. But the limit price just remains that limit. It doesn't get adjusted through the day automatically. I hope that answers that question. How does the limit mode work? Any other questions? We do the calculation using, I think it's a 5-day ATR, but let me just see. I know it's in a pop-up. Hold on. Because I designed this a while ago and I don't remember exactly how I did it. There we go, limit mode. Okay, conservative. All right. Okay, so here's my actual formula for the ATRs. So conservative and patient orders adjust the most recent price by a fraction, 1/3 for patient and 1/6 for conservative of the stock's average true range, a volatility-based measure, less 1/10 of the average bid-ask spread. For example, if stock's current price is 100, its average true range is $3, and its bid-ask spread is 10 cents. A conservative buy limit order would be 99.51. A conservative sell limit order would be 149. A patient buy limit order would be 99.01, and a patient sell limit order would be 199. Yeah, we only use daily ATR, not hour bars. And I believe we use a 5-day ATR, but I'm not 100% sure. So I hope that answers that question. Any other questions? Okay, I'm going to go back to the PowerPoint. Now, 14 days. Someone said ATR is 14 days. Okay, 14 days. Maybe we use 14 days. I'm sorry, it's been a long time. We are going to distribute these slides. They will go to everyone who attended. You'll be getting them via email. And this is the last of the webinars that I am giving. I am also planning, though it may take me several months, to write all of what I've said in a series of blog posts, though they will be less specific to Portfolio 123 than these webinars are. These webinars are all archived. If you go to Portfolio 123 and click on webinars, or click on Learn and Connect, and then on webinars, then you'll be able to access all the webinars I've given. If you are not a current member, then you can we have a 10% discount, or even if you are 10%, if you are 10% a current member and want to upgrade your membership, you get a 10% discount. The blog that I mentioned is at blog.portfolio123.com, and it's accessible to anyone. You don't need a membership, or you don't need to sign up. Any other questions? Please, in your document, tell how to trade with Portfolio 123 and IB. I don't really have that, but because the slides are already there. But if you go to our website, let me just exit out all this. Under Learn and Connect, knowledge base, I want to show you, there's a part of the knowledge base, Manage Introduction. And this gives you all of the stuff you need to know about how to manage your IB account through Portfolio 123, and how to use it for trading and that kind of thing. And both Paul and I are very happy to answer more questions about it. I think that it's pretty self-explanatory. Once you set up an account with IB and you link it to Portfolio 123, all the questions and answers are kind of right there. The interface is very easy to use. You don't have to write formulas, you just click on buttons. And it's free. Any other questions? Okay. Well, thanks very much. And have a good week and good weekend. And look forward to interacting with you further on the Portfolio 123 forum, or in any other way you want to get in touch.